Julian Chillingworth, he's Chief Investment Officer at Rathbone. Julian, thank you for coming in the studio. Now, it does seem pretty incredible that for the last 6 months, even more, we've had this incredible rally, although there's a lot of hiccups along the way for companies saying, well, costs are going up, you know, we're not quite there, the recession is not quite full. Are you surprised by what we've seen?
I think I was surprised to a degree by the last leg of the rally, because I think what we had was a good example of a roller coaster in human emotion. People got extremely depressed back in February, early March, and they thought the end of the capitalist world was coming to an end. And then we moved on. People didn't believe the rally to start with, then they joined in, and so you got that climbing that wall of fear. And then we reached euphoric state in the third quarter, and that's where we arrived at. And now I think a pause is probably likely as people readdress where we are.
A pause triggered by what exactly? Because a lot of people were surprised that actually Dubai wasn't the trigger. A lot of people saying that the markets are just waiting for an excuse to try to start selling. Will the US jobs report be the clincher if it's not great?
I think what Dubai told us was that not all the problems are dealt with. That you know, we've been through a period of excessive leverage, and consequently we're going to have to see that unwound, and that's not going to take 6 months. It's going to take 2, 3, 4, maybe even 5 years to work through the system. Front page of the FT today talking about £30 billion worth of property loans outstanding. That's just another piece of evidence. So I think it's going to be those sorts of pieces of evidence building, and what the trigger is, you never know in capital markets, do you, what one small catalyst can get people to sell down 5–10%.
But as an investor, what do I look at, Julian? I mean, US data, do I keep my money in there for a couple of months?
I think I'd say this to all investors, that over the next 12 months, you still want to be in the equity markets. There's going to be setbacks. I mean, it would, as I say, no great surprise if we came back 5% from where we are. We've had a very strong rally. But I think as long as we don't see a tightening by the Federal Reserve before the third quarter of next year, then I think equities are absolutely fine.
And what would you be buying?
I would be buying probably those companies that slightly lagged in this rally. So not all those over-leveraged industrial companies, cyclicals that have shot up. I'd be looking at some of the consumer defensive names on lower ratings, good cash flow, and if you're a UK investor, looking at overseas earnings, because I think sterling will remain weak.
All right, great. Thank you so much. Top tips there from Julian Chillingworth, Chief Investment Officer at Rathbones.